Welcome ADK Wealth Advisory Group community and financial planning world. Dan Davis coming to you from our Franklin, Tennessee headquarters. Wanted to just respond to some calls that I've been getting recently from clients with jitters, concerns, headline bothers, etc. I find that when I get a certain number of calls come in on similar topics, it's probably a good point to message out to you, with this being the last trading day, February 27th, 2026. So what do we see happening? What are our concerns? What are our expectations? So what I see happening right now really is a lot of volatility. January was good. February was not. It probably feels a lot worse than what it is. And what I mean by that is, if you were to take a look, it's around 11 o'clock when I'm doing this on Friday, February 27th. The Dow Jones year to date's down, low single digits, call it 2+%. S&P's right in the same range. NASDAQ's down maybe 4%. And interesting, the Russell 2000's up about 4%. So you can kind of see what I call as a capital market rotation. I've explained it before, so I won't go there at this particular point. But because of the concerns with AI and the amount of spending and capital expenditures, investments it's going to take, there's just a lot of concerns of what's AI going to look like? Is it overbaked, etc.? My personal belief is that it's not. You've heard me say that the thesis that we have is that we're sort of in like dial-up internet stage of AI. When I go into whether it's ChatGPT or Gemini or Anthropic's Claude, any of those, they do really good 90% of the time, and 10% they don't. It's machine learning, and they're learning, not learned. And the long story short, no one knows where this is going to go. And so it's our belief that, if you went back to like the late 90s and you said, let's invest in like 20 really good names that are tech-based, maybe 3 to 5 of them don't even exist. Not because they got bought, they went bankrupt. Maybe 5 of them merged in with others, and then the rest of them did really well. I think you'd be really pleased with that kind of returns that you'd have over that quarter of a century. I think the same thing holds true here, but that's why they say investment involves risk-taking. And right now there's a lot of jitters around this. It's causing a capital market rotation. I think it's natural, but I don't think it's anything that I'm concerned about long-term. That said, another thing that you're seeing is right now emerging markets are probably the leading asset class. So you talk about the acronym BRICS. You haven't heard me talk about that in a while because there hasn't been much to talk about. And then the frontier investments, frontier stuff like Vietnam. There's a lot of countries that aren't in the BRICS that are frontier oriented, and they're doing really well. I would expect that to continue for a while. There's a lot more risk there because of the fact that they're an emerging market. Another thing that I see happening is that the growth markets have done so well, 2023, 24, 25, that they did so well, it was time for them to take a pause. Now, will the pause be more of a sideways consolidation, where it's like this? Will it be something that drops down a lot and then does that and comes back up? No one knows. But there's no moves that we have recommended at this point in time. What are the major concerns that I have? You've heard me talk about shadow banking. Heard it in our last market update because we had a couple bankruptcies in 25 that the lending that went out to them came through shadow banking, and it was a real mess. And so then you saw one of the major players that is a fund that accumulated assets, lent them out. They are having significant problems, and they've actually closed the fund so that people can't sell to get their assets out, and they've had to sell a bunch of the bonds that they had in order to keep the thing afloat. So we've stayed away from that. Things like Blue Owl and that grouping. We don't like shadow banking. What is shadow banking? Shadow banking, if you think of it in traditional terms, banks lend money to people and institutions that need money for capital projects. Well, after Dodd-Frank, a lot of that lending tightened up. And so then you had a ancillary market pop up that would create those loans in a way that was similar to banking and that you apply for it and blah, blah, blah. But what's very dissimilar is that's very opaque. It's hard to see what's going on there, thus the phrase shadow. And the biggest concern that people have in the investment market is that if you raise money and then you don't really get paid on that money until you deploy it, are you really making great decisions to deploy it, or are you deploying it because of incentives to get it done? The answer is no one knows, but more often than not, you end up with some stuff in that's baked in that's got problems, and it does at this particular point. It's not just a U.S. thing, it's a global thing. What will it mean? Directly to us, nothing, because we don't own any of that stuff. But it'll have a secondary impact, but yet no one really knows because we just don't know what kind of reverb it'll be. Is it something that is just rattling right now and doesn't really do much for a while? Or is it something that creates a shock? I don't think that that's the case, but it's possible. And in any case, we've got a close eye on it. And the other thing is if you take a look at Powell, the U.S. Fed chairperson, he's done, in my view, a great job. Great job doesn't mean perfect. I mean, even if you take a look at some of the best baseball players in the world, they certainly don't have a batting average of 1,000, so I don't expect a Fed chairman to either. I think I'd give him an A. And his term comes up in May. We have Wash coming in, and Wash is a past Federal Reserve governor, so he's got a ton of experience. But anytime you have a transition from one to another, there's uncertainty around that. The other thing that's uncertain, if you go back to, say, Greenspan, Bernanke, Yellen, and Powell, they all came from more of a classical economics training, philosophy, belief. It's the way that I was trained as well. When they would have policies, I understood what they were talking about. When you take a look at Wash, well, he's got a ton of experience. He's not a classical economist, and he's got divergent thoughts. Does that mean it's bad? No. It could be. I don't know. The reality of it is that when I read some of his stuff, I scratch my head because he says if I do these things, it's going to lower interest rates. Well, when I see it, it causes me to think he's going to raise interest rates, not like raising the discount rate, but monetary policy that has an effect that causes rates to go up. If that happens, that'll be a disaster. Now, the guy's significantly smarter than me, and he's 2 of maybe 12 on the board. So it's not like he can go in and then just autonomously start moving things around. So he's got a committee that works through the whole work. So that's another big issue. And then the third is just the ongoing geopolitical mess that we've got out there. The reality of it is that can flare up at any moment and create problems. So that's why we've always taken what I classify as a dynamic allocation approach versus a static allocation. What does that mean in English? We're not just set up to ride through any storm because we believe that you shouldn't, ever sell out. If there's things that we think we should do, we'll do them. There's nothing that we're doing right now. We made some purchases in the January, February timeframe in the space of rare earth, strategic minerals, and then quantum computing. And we think that precious metals, rare earth, strategic metals, that they're going to do really well over the intermediate time frame. The real risk there is what I'll call China dumping. And that's more around rare earths than it is around precious metals. We saw that when we invested in lithium. Great story, didn't work out. Reason it didn't work out is China was dumping. So when we start to see anything that would be a China dumping kind of thing, we'll evaluate that and decide tactically if we should do anything defensive. But as of right now, our expectations really are no different than at the beginning of the year, that we expect bonds to do somewhere around 6%, and we expect stocks to do somewhere around 7 to 11. Anything above 11 would probably be PE expansion, which basically means that things are getting overvalued. Earnings in Q1, I would say were really good. You could oversimplify it and say earnings were up about 13% in the S&P 500. So there's no signs that corporate earnings are in a mess or anything like that. They're growing well. You wouldn't know that from headline news. When headline news starts to get you bogged down and freak you out, I'd recommend watching less television, going out for a walk. Springtime is in the air. We're going to sign off from Franklin, Tennessee, and say thank you for your trust and your time. We're here if you need anything. Have a great rest of the day.